Welcome to Wattle Partners monthly update. As usual, Drew Meredith has joined me to talk about the month of February. Markets went up, markets went down, Drew.
Primarily down, yeah. So I think it was 4 straight weeks of declines for February.
Yeah, last time we were here, we were all heroes talking about how good markets are.
Exactly. And it was, followed a difficult finish to the year and then a fairly positive start. And we're kind of getting back into this, I think they called it the kangaroo market last year, where it bounces up and down all the time.
Sure. The same concerns in February as we had, in January and December. So, focus on growth, focus on will there be a recession, won't there be a recession? But we also had reporting season.
Yeah, massive reporting season. And not much has changed with the broader theme of markets. And I know the day we're filming this, the RBA is going to make another rate decision as well. But pretty solid reporting season. It said something like 137 companies out of the ASX 200, or the 200 biggest companies reported. One of the headlines that came out was the impact that, company profits and passing on costs is having on inflation.
Sure.
Which is a pretty, not necessarily topical, but quite a touchy subject in a lot of parts of the market. But broadly, dividends were up 5%.
So that could be supply chain, that could be interest costs, that could be a whole heap of costs increasing last year.
It's much easier for companies to pass on the input costs to customers, at least for a while anyway, before you find out how elastic demand is as you increase your prices. But groups like Boral and Brambles that have seen energy prices go up and input prices for plastic go up, have to pass it on, and at this stage it doesn't look like demand's been impacted.
Do you think that's probably because the consumer was in a pretty good spot post-COVID? Savings rates were up. They had cash reserves. They were ahead on mortgages. So, when it came to an inflationary environment, they could afford a bit more.
Exactly, and I think they're still running it down. I think we're looking for some more specific data on cash buffers, but it looks like as the savings rate's fallen, people are running with multiple pressures on their savings. People are starting to run down their cash buffers.
Yeah, so savings rate is just the rate that a household would save out of wages per month. Through COVID, that was up to nearly 20%, wasn't it?
Record highs, I think.
Yeah, that's right. So it fell again in the month of February. That might be a quarter stat, actually, from 7.1 to 4.5. Yeah. So you can see the impact of higher costs, the impact of higher debt is having an effect. As Drew said, we don't actually have the net cash saved at household rate. We'll get that next time, but we assume that that's being eaten into quite aggressively.
And I think it's pretty interesting. We forget what happens with retail sales, that when you get retail sales, it's the total amount of goods sold. So in December, I think it might have been slightly up from memory. But if you include inflation in that, it was actually negative, and it was only the price increases that were showing retail sales going up.
I think they were up, down and up, weren't they? So they're up in November, down in December, up in January.
And then as soon as you include inflation, it looks even worse. Like if you adjust for inflation, the only increase is coming from prices at retail stores and cafes, and obviously travel's been incredibly expensive for the last 6 to 12 months as well.
Sure. Saying that, Qantas is about to
release
$1 billion profit, so it's not bad for everyone. China continues to surge. It seems like the juggernaut, which was China for many, many years and has been absent for a couple of years, is starting to be turned back on again.
Yeah, I think, to us, it was kind of obvious without saying that it was obvious. Like every other country in the world, as soon as they finished lockdowns during the pandemic, saw a massive flood of stimulus or a massive flood of consumer spending as people were released again. And it was assumed that wouldn't happen in China for some reason. Sure. I think the geopolitical kind of overtones that were happening, or undertones that were happening, had scared people away from China. But the economic data is strong, manufacturing is going up, demand for iron ore is strong, infrastructure spending, everything's looking reasonably strong there. And the economy and spending is recovering at the same time.
Sure. I talk about the levers that an economy has. So, monetary policy, fiscal policy and exchange rates. But if you think about the way I think about China is that they've got more levers than anyone else. And, the Western world's a bit scared of that, but they can control their economy and their people down to the nth degree. So if they want to slow it down, they'll slow it down. If they want to make it quicker, they'll make it quicker.
They've avoided inflation because they're so vertically integrated in most of their supply chains. I know there's a lot of talk about deglobalization and businesses investing, Intel trying to invest back in America, but it takes decades to extract, your supply chain where it's completely located in China or Asia at the moment.
Yep, that's right. Took 40 years to globalise.
Yeah, it doesn't take 3 years to
yeah.
deglobalise.
That's a good segue into BHP. BHP had their result through February.
And just a reminder that BHP and all mining companies are cyclical. So I think earnings were down somewhere between 30 and 40%, mainly because like this time last year, the iron ore price was, I think, $120, $130 a tonne. And naturally the price has fallen off. And with it, earnings are falling, cash flow is falling from high levels, of course. So not necessarily, it's not in trouble. But the dividend was cut 40% as well.
Yeah.
Which, one of the issues and one of the things we talk about a lot is disconnecting or trying not to just focus on what the high, the headline dividend is for a company, because it can, particularly for cyclical companies, disappear or be adjusted quite quickly.
Yeah, I mean, BHP management has done a good job this time around. So in a market boom, they didn't go out and buy something or overpay for something, and they really rewarded dividends rewarded shareholders and probably themselves by paying a higher dividend. So something like BHP, you can't really budget into your annual cash flow at the full dividend. Maybe something like 40 to 60% of the dividend that they were paying you could rely on, but not the 100%.
And they had this issue in the past, I think it must have been 5 years ago now, that they had a progressive dividend policy that meant they kept increasing it every year.
Yep.
But for a company that earnings are determined by the price of commodities, it doesn't make sense to force your dividend to go up.
Yep.
And I think it's a better way to manage a company is to determine the dividend each year by your profitability, give or take.
Sure. Hard to forecast that, to build a portfolio,
Exactly.
but I know exactly what you're saying. And we saw a win for investors through February as BlackRock cut their costs on their core ETF range, which, again, you and I have kind of coined this phrase about beta for free, and it's not quite free, so read the fine print, but it's pretty close. So I think some of their core products are now 0.4 of 1%. So that means mum and dad investors, it means our clients, it means anyone can get access to global first-class ETFs that follow the index at a very little cost.
And that was IOZ, wasn't it? The ASX 200 tracking ETF.
Yep.
And I think clients have probably seen we're embracing some of the lower cost core,
Yep.
whether that's overseas or in Australia more recently. And part of that's the nature of where the market's been and where the market's adjusted in the last few years, and almost the difficulty in adding outperformance or alpha.
Yep. The excitement for me is the brands associated with those cuts. So, if you're thinking about the core of your portfolio, to me that would mean certainty and safety, and following beta, that makes sense, and then cost, that makes sense, and then aligning yourself to, very good brand names, and BlackRock and Vanguard are the best in the market. So you're buying an A-grade product at that price. So I think that's a big win for investors. It's a big win for advisors as well.
Yeah, definitely.
Should we move on to just our model portfolio? Obviously, the month of February was down, so we're not immune to that. Is there any key highlights you want to bring up?
I think the model was slightly very raw data. It was up slightly, 0.1% for the month, but we're waiting for the rest of the benchmarks to come out, and they would all be slightly down. The highlight for our own model was the continued outperformance of our domestic equity portfolio, that when we're building it direct, so probably the most boring portfolio of stocks. Yeah,
so for the people that haven't listened to us or don't know us that well, when we talk about model portfolio, essentially Drew and I run a model, a theoretical model, where all the decisions that we would make at our investment committee affect the model. So therefore our record, our history, our decisions can be measured against the industry as a whole. We build tailored portfolios for clients, so essentially every client is slightly different, but in terms of our decision making or our framework to make decisions, they're measured in our model portfolio. So when we talk about model, that's essentially it.
Yeah, so when we have our investment committee meeting in the first, immediately after the end of the quarter, that decision is implemented in the model, and it gives us something that we can track against, because obviously timing can be an issue for some clients at different times. So, yeah, direct shares or ASX listed share portfolio was essentially flat for the month of February, and the ASX more broadly was down 3%. And the biggest driver of that was a couple of boring companies, which is one is Origin Energy. So
you get a lot of boring with us.
I think when you're building portfolios for retirement for a focus on income, boring and resilient is kind of what you want. You want exposure to. You don't want companies that are going to be going up 30% one week and down 30% the next. So one big one was Origin. So they had a takeover offer.
Yep.
That's the diversified, vertically integrated energy player, renewable energy, owned part of Octopus, one of the best, fastest growing renewable energy providers in the world at the moment. Have power stations and have a retailing business. Yep. They had a takeover offer from a consortium of private equity groups, and then Boral.
Yep.
So produces cement, and Cube, which runs ports basically in every city in Australia.
Sure.
And they were all up by more than 5% for the month of February, which helped offset weakness. And broadly, most of the weakness was in the materials and banking sector in February, driven by those reporting season announcements.
Yeah, that's right. The small caps had a poor month. Banking sector reported okay. CBA report was pretty good.
I think record half-year profit, 5.2 billion, but there's concerns that their interest margin, so that's the difference between what they lend at and what they borrow or raise money at, there's concerns that it might have peaked at 2.1%, which means their profitability might have peaked. But personally, I think we've heard this story plenty of times before, and CBA has one of the best franchises. I think 75% of their loans are funded by deposits. So
that's pretty simple, isn't it, right? So you get money in as a deposit, and then you lend it to a home loan, someone that's got a mortgage, and you make a margin on it. And roughly banks make 2%.
Good ones, Yep. Most of the other banks are down at 1.6 or 1.7, but improving, and CBA is just the most powerful bank, then it's over 2% again.
And 1.6 to 2 doesn't sound much of a difference, but when you times it by $500 billion worth of loans,
it's a bit.
It makes a difference. Okay.
I think one of the good news parts, or one of the good parts of the CBA report was that the dividend is pretty much back. The interim dividend is pretty much back to where it was pre-pandemic.
Yeah, okay.
Took 4 years to get there.
Yeah.
But slowly creep back up.
Yeah. I mean, so we talk about mortgage stress. There's a lot of mortgage stress out there. The banks are maintaining their margins by pushing the interest rate changes from the RBA directly onto borrowers. So there's no buffer being felt by the banks. Different to on the way down, where the banks were capturing some of the margin, and the RBA didn't have direct control. On the way up, it's different because the banks hand over every cent on. So
I think one of the interesting parts about the CBA announcement was that the CEO came out and talked about protecting borrowers from interest rate hikes. So he was calling out the pressure that the RBA was putting on. He's naturally passing it on.
Sure.
But calling out the pressure they were putting on and telling borrowers to contact their bankers and that they will seek to support them rather than pushing them into arrears or into default situations. So it's kind of this, believe it when you see it, but this kind of good corporate citizen banker is coming back.
Just made 5.5 billion.
Yeah.
Still remains our favourite bank. And one of the reasons it remains our favourite bank is because it is the biggest retail bank in Australia.
Yeah.
So what it means is that its ability to fund is probably greater than the rest. It doesn't have to offer interest rates that are a lot higher. So at the moment, CBA, maybe we'll talk about interest rates a little bit. So the good part about higher rates is that for retirees, they can get more on their cash. And for us as portfolio managers, we can see how traditional Markowitz portfolios work now because you've got bond rates that are higher. But CBA for 12 months pays 3.8%. Yeah. And there's some other interesting rates around. So Judo pays 5% for 5 years. Let's assume you're under the $250,000 guaranteed amount. That becomes a really attractive rate for some people.
Yeah, 5% for 5 years. That's a lot of the income that most people need.
Yeah.
From a portfolio.
So people are starting to have a choice. If you want to opt out of markets, if you want to go, I just need to earn 5% for a while, then essentially you could build a portfolio of bank term deposits, probably 4.5% to 5%. So there's some interesting rates around. Macquarie's got a savings rate which pays 4.5% for the first 4 months. ME's got a 4.35 for 12 months. Of course, these rates will probably change today if the Reserve Bank increases.
Have you got a prediction?
I'm closer to the end than I think everyone else is, and I probably shouldn't be saying it on a podcast. But I think they'll raise today, and that's it.
Yeah.
But that's probably out there in terms of expectations. Your view?
Yeah, I think we agree. Yep. What was it? There was something about a one-armed economist?
Yeah.
There was a joke around the office. Not a joke. A story. But I think there's so.
That was actually Rob Pruget's article.
Yeah.
We can put it up on our website if anyone wants to have a read. It's really interesting about how economists go about controlling the economy. So.
Yeah, I think there's so much pain on the street compared to what I think a lot of people, whether it's in finance or in government or in the Reserve Bank, can see. They rely on data and sentiment that comes in, but spending's changing. You look at some of the announcements from Woolworths and Coles and Bunnings and these other groups, and energy prices are still going up. Repayments are slowly feeding through on mortgages, and rents are out of control at the same time. So there's so many things pushing on the consumer, and we still don't know how much of an impact.
Well, it's still very early too, right? So rates have gone up nearly every month for the last 12 months. So next month, your mortgage repayment, if you're 100% variable, is going to be higher than it has been for every other month. So you've probably whittled through your savings. You're probably somewhere in your reverse mortgage situation now where you're not paying all the interest costs, but your mortgage is drawing down. Food is becoming more expensive. I feel sorry for the people that have bought a house in the last 2 years where they bought it on a mortgage rate of 1.99 for 2 years or 3 years. That's going to expire soon. Their mortgage is going to double. Imagine being young with a kid, one of you are earning 70 or 80 grand and you're trying to pay a mortgage, and the mortgage rate doubles for the next month. And then if their options are very limited too, so that needs to play through the system. We haven't had a sustained fall in real estate for a very, very long time. We've had falls in real estate, but essentially the RBA has stimulated and real estate's come back. So it's given the mortgagee holders an option to sell out. But at the moment, if you've bought a house in the last 2 years in the wrong suburb, you could be 20 or 25% down. So you probably have got a mortgage greater value than your house. Most of us, I'm 47, I can't remember that. And what happens if you want to sell it? So you go to sell your house, but the bank's not going to give you the mortgage back because they're owed, say, $800,000, and you sold your house for $760,000. So therefore you're stuck, but you can't afford the payments. So there is a problem brewing, and quickly. The only thing that saves everyone at the moment is that we've got full employment, and maybe my old man always had 2 jobs. Maybe people taking a second job or trying to get a bigger pay rise, but there is a problem.
I think it is the issue with a lot of the talk about increasing interest rates and slowing the economy is essentially looking at increasing unemployment.
Yep.
It actually is an outcome of doing it, which is not a positive for the people losing their jobs. So it's quite challenging. And there was Nouriel Roubini, who I'm sure we've all heard about all the time. Dr. Doom, is that his nickname?
He has many, Drew.
He has many nicknames. He even came out and said that he expects, this was yesterday, the central banks to blink first and cut rates because it's the only option, because they're worried about sending the economy into a deep recession. I'm like, fair enough. I don't see a problem with cutting rates to avoid a big jump in unemployment, because we know what ingrained unemployment does for an economy as well.
Sure. I mean, reserve banks and the Federal Reserve haven't really made us feel warm and fuzzy over the last 20 years. So, they always cut too hard or go too hard. Yeah. And everyone's expecting the same thing here, where they've gone too far, they've created pain, the pain starts to unwind, and then the only thing they think they can do is cut rates again. So and we're a little bit all over the shop this month, but that's probably why within our bond portfolios we're adding duration back.
Yep.
So we have a view that rates are probably going to near top inflation seems like it's coming under control if you look at all the inputs, whatever inputs you want to look at, and duration in fixed income portfolios makes sense. The easiest way to think about that is that, am I saying it is Judo, isn't it, the bank?
Yeah.
Judo.
Business bank, yeah.
Yeah, so Judo, that 5% for 5 years is pretty attractive. And, all we're saying is take it while it's there. That's essentially what duration is, right? So when we say we're adding back duration, we're taking the fixed rates that are on offer.
You're getting paid to hold government bonds or low-risk assets again.
Yeah, that's right. So this is within the $250,000 guaranteed amount from the government. So essentially it's the same debt as the government. You might have to wait 3 months to get your money back, but essentially it's paying 5%. So you could argue you're paying 5% on the Australian government. So but that one of the things that investors have made mistakes on, and over cycles we've seen this, they lock in for a lower rate. So they go, but I can get 4.35 for ME, so I won't go 5 for Judo. Of course, in a year's time, that 5's not 5 anymore. It's 4 or 3.5. So you need to think about how you're locking in rates. What does it look like? I mean, we use bonds to do that, but essentially about 2/3 from investment committee to us now. About 2/3 of our fixed income portfolio is back in terms of duration. Now,
it's similar to what happened in 2007, wasn't it, when we talked about 7% term deposits or 8% for 5-year term deposits.
Yeah, we couldn't sell any of them, remember?
Equity markets were doing, or share markets were up 20% the year before, so no one wanted to buy a 7% term deposit. But we will be in a position, hopefully interest rates don't go up that much further, but we are more comfortable definitely recommending lower risk at these sort of income levels.
Great. You and I attended an alts conference, so for advisors last week. That was good. Some good ideas, some really interesting strategies. What was institutional grade product is coming to wholesale investors like us and our clients. Was there any takeaways from that alternatives conference that you saw?
I mean, we've been pretty patient in allocating to or investing into private markets. We've kind of gone in slowly because we're wary of valuations, and it's this valuation. Because of interest rates going up, private markets tend to devalue slower than share markets like the ASX. So I think we're starting to see more and more opportunities than ever.
Oh yeah,
and I think there's some great diversity.
So go slowly there. Yeah. There's a question mark around private market equity valuations.
Yep.
But as an investor, you can go into two things, right? You can go into something that's already priced.
Yep.
Or you can go into a new fund.
Yeah.
That's how private equity funds, right? So they raise cash and then they'll be buying deals for the next month, year, 2 years, 3 years. Yeah. So probably if you're worried about valuations and you buy more a cash fund, that would be okay.
Yeah, then they're starting slowly. They call it opportunistic, which can sound negative, but essentially you're investing progressively into options or investments that become available and not buying a fund that already has investments they've held for the last 5 or 10 years.
Yeah, okay. So maybe next month or a special session we can talk about superannuation funds, industry funds, and when you buy into them and they have alternative assets and what you can do to minimise that effect. Anything else out of the alts conference?
I think just that valuation question was central. More and more, outlook for lending and property.
Yep.
I think there's been a proliferation or a lot of growth in direct mortgages and that sort of thing, which we've always strayed away from.
Sure.
So the importance of security and quality and when you're in private markets who you're lending with was probably one of the big messages as well.
Yeah, there was a good article yesterday around fees.
Yep.
So this fees issue about how direct lenders earn their keep is really interesting. I'm going to keep my eye on that and see what happens. So it's not just the MER that you pay, but sometimes it's also the origination fees that aren't included in ICRs and costs. So I'm sure that story, as the Fin has kind of cracked it, it is going to unravel over the next 6 or 8 weeks. We also did the Ethical Investing Masterclass by Australian Ethical, 2-part series, in depth. We're seeing this concept of investing better, ethically, sustainability with concerns about climate growth.
Yeah.
Most fund managers have ESG within their process. We've always had a strong belief that it's not just about corporate gains, it's also about, community and society as well. I mean, we've been a B Corp.
I believe we were just approved this morning.
You believe, you text me at 6 o'clock.
The most intense audit I've ever had from the B Corporation community.
So again, for people who don't know us that well, B Corp is an association started in the US, and we've been a member. I think we were the first financial planning firm to be a member. Must be 7 or 8 years ago now.
Yeah.
Essentially, it's this idea that it's not just a pursuit of financial profits. There's also other things, taking consideration the environment and society, and you have to every 3 years, is it? You need to pass an audit about what you're doing. It's quite a deep and thorough audit, so it asks questions about policies and what you have on constitutions and the role of gender balance and
how you treat your employees.
Yeah,
and
I think it's a really
customers.
good audit, not just to get a certification to say we're B Corp, but a good certification as a business owner to make sure you're doing everything you possibly can. So so then let's just kind of discuss one or two things, and then maybe we'll call it time. But we saw a big change in legislation around superannuation. Every government tells us they're not going to play with superannuation. Every government plays with superannuation. So once again, they've got the tax for the rich, and superannuation going forward looks like it will be capped at $3 million.
Broadly, I mean, as everyone probably knows, there's already caps that once you're up to 1.7 million, you can't contribute anymore. So this is essentially a tax on an additional cap.
Yep.
The proposal is that for you can't have a balance over for your balance over $3 million per person, not per fund, but per person. So it could be in an industry fund or a SMSF.
Could be multiple funds.
Yeah, exactly.
Yep.
Across the board for the portion of your money in superannuation that exceeds $3 million,
yep,
the earnings on that will be taxed at an extra 15%.
Yep.
So that technically it's not a cap, you don't have to take anything out. It may, given that takes the tax rate for a portion of superannuation up to 30%, for some people it might be better off holding outside of superannuation eventually. Maybe.
Depends how much. If you've got 5 million in excess.
Yeah.
Probably not.
Just depend, because you're comparing it to your marginal tax rate, and I think if you had over $35,000 or $40,000 in income in your own name, then you're better off keeping in super.
So this is really a tax for the rich that already are rich.
It's a political decision, and as the headlines probably show, it only impacts 0.5% of people in the country. Because
the caps the way they are, and I think about my superannuation, I'm not going to get to the cap, right? I've pretty much put the maximum in every year, which is $27,500 minus contributions tax, so $28,000. I'm 47. I think my balance is $500,000.
Yeah.
If I contribute the same, if I have a good advisor, Drew, maybe you need to look after my account. I'm not going to even get to the one. I won't even get to the 1.9, right?
Exactly. Yeah.
Even if I start putting extra contributions, I'm not going to do it. So it's really a tax for the guys that used to use the rules to put majority of their wealth into
companies. Some have held companies in there. Some have held big property developments in there. There's a fund that has $500 million into it, an SMSF. So it's very targeted on those. And I think the interesting thing was it only raised $2 billion.
Yep.
Or it's only said to raise $2 billion. And comparison to the deficit, the amount of interest the government pays, it doesn't really move the dial.
When interest rates go up, does the government need to pay more debt, more interest? Like a household, when interest rates go up, I have to pay more interest?
Not immediately.
Not immediately.
So the government is paying interest. Usually, governments can issue bonds at essentially any term up to 50 years.
Okay.
And every time they're raising money in the bond market, they'll pick the best term. Could be 15, could be 17, whatever that year is. And the interest rate on that bond is, I think, 98% fixed at that time. Yep. So it takes a long time of maturities and new debt issues for interest to go up significantly.
So it's only when the government's debt rolls, and we don't know the maturity of that, but if it rolls, they'll need to issue a new Australian government debt bond, and that'll have a prevailing interest rate you assume would be substantially higher than they used to.
Yeah, exactly.
So the interest cost slowly increases.
Yeah, and it's not. I mean, people talk about it like it's an incredibly pressing issue, but it takes. I think the interest the government pays is like $160 billion a year.
Yep.
And we're raising $2 billion from this policy. So but I think it's not as a pressing issue. I think over 10, 15 years it becomes something to be considering.
Sure.
But interest rates will change by then as well.
Yeah, the majority of debt is probably owned by the superannuation funds and the future funds anyway. So.
Exactly.
Sure, you can legislate something against them. We did have a note here about Atchison models. Do we want to talk about them?
I think people were probably talking to people where Atchison's part of our business now. They're helping us build governance and structure around our investment, or more governance and structure around our investment decisions, helping us drive returns via strategic asset allocation and leveraging off their networks. So they advise other super funds, they advise platforms, they advise other financial advisory groups. And we're trying to put together almost a best of breed style portfolio. But also one of the big messages there was our ability to deliver fee discounts for things we're looking at for our clients by this greater negotiating power that we have with Atchison's.
I think that's, we're trying to leverage a few things. Well, you and I are trying to leverage a few things for our clients. First one is technology. How can we execute, implement, and administer a portfolio better and faster and quicker than we ever have? We all know we can buy shares on the ASX and get the forms and fill them out and send it back. But, how do you do it better? How do you extract more return? We're talking maybe 0.5% or 0.75% per year, but if you compound that over 20 years, it's a lot. So how do you use technology? And then how do you use knowledge? And our purchase of Atchison a couple of years ago was all about, hey, these guys have been running institutional quality portfolios for a long time. What can we learn off them? And then understanding our clients. And, our clients, we build bespoke portfolios. We provide bespoke advice. But for a lot of people, they want us to do the lot. They want us to, especially when trusts pass or people get older. We know our client base is essentially 70 plus. So a
lot of travel.
How do we execute better? And that's this idea that we're building more model solutions, very fee appropriate for clients versus building a portfolio from scratch. The truth is in the pudding because, we've run our model portfolio for a while and the model seems to do better than most clients' portfolios because we can execute the model very quickly and efficiently and without lots of consultation. No offence to clients, but consultation, and clients do have the habit of having biases and cherry picking, so they might not get the results that they're after. But
having fun sometimes.
And having fun, that's right. So, there'll be a lot more about Atchison, and maybe we'll get Jake on next time just to talk about what we're doing in models and what those solutions look like.
Yeah, definitely.
Anything we need to look out for in the month ahead, Drew?
I'd say the one thing to mention quickly was that the Cooper Asia Fund closed, returned all money to investors. So probably a good experience that as much as we don't like the news that a fund's closing down, when it's invested into shares, essentially you just get paid the value of your shares at the end. Money isn't locked up. You don't lose out of it specifically. So that cash will be in bank accounts already. Yep. And we'll be looking to deploy that in the next round of quarterly reviews.
So still the mystery of managed funds. You're trying to unravel the mystery of... I did forget one thing, actually. Maybe we'll go back. I want you to explain, in the term for the month, I want you to explain PMI. What does PMI mean?
Purchasing Managers Index is a PMI, and it's essentially a measure. It's basically like an Australian Bureau of Statistics or that sort of group will go out and survey a broad range of businesses and get their buying and investment and spending intentions for the coming 6 to 12 months. So it's like a forward-looking indicator of what's happening in the broader economy. By rule, if it's above 50, it's positive and expansionary. If it's below 50, it's negative and the economy is expected to slow. And for instance, the Chinese data last week was 55.1, which is the highest it's been in about 7 years. That's why people were so confident about China at the time.
Great. Thanks, Drew. Thanks, everyone, for joining us. That was February. If you have any questions, feel free to email Drew or myself. Thanks very much.